once again. Welcome to another edition of Strategic Financial Management. In today's class, we shall be looking at one of the important topics in strategic financial management, which is bond valuation. The question now is, what is bond? Please, I don't have, okay, maybe after the class actually. Please pay attention to bond is very important. I think in the last two diets, ICANN is not yet to test some questions under bond, which is the credit rating part of it, right? Of which we'll look at that if time permits us today. Now, what is bond valuation? What is bond? First thing we need to understand the definition of bond. Bond is a debt instrument requiring the issuer, that is the borrower, or the lender, to repay back the interest, requiring the issuer, which is the borrower, to pay back the interest and the principal to the lender as at the date of maturity. Class. What we will be talking about here in this class will be purely practical, and some other parts that is not practicable, I will actually mention it. Then we'll move on from there. Now, recently, federal government want to raise a bond about 50 million or 50 billion, something like that. Now, who is the borrower and who is the lender? The federal government is the borrower because they want to raise the fund. It's the sources of finance to the government. Who is the lender? The general public, the investors who have interest in the bond, in the bond, which means that it is requiring a company or the government to pay back. There is an obligation to pay back the interest and principal as and when due to the lender. Of course, when you borrow 50,000, the lender is expecting 10,000 return on investments. At the end of the day, the date of maturity, probably 2 months, you pay back the interest and the principal. So bond is a debt instrument, right? If that is well understood, we will now move to characteristics of bond. Characteristics of bond. Class. Okay, characteristics of bond. 1, par value. Characteristics of bond, right? Characteristics of bond. 1, par value. What is par value? Par value is the face value. You can say par value is the face value of a bond. Is a value stated on a bond, or is the amount stated on a bond. That is par value. Par value or face value. It is the value stated. Yes, let me use stated on a bond, or the amount stated on a bond, just like a nominal value under equity. So, par value under bond, par value could be 100 or 1,000 naira. Another name for par value, we could have par value, nominal value, or face value. They are the same. Par value, nominal value, and face value. right? The question now is, what is par value? Par value or face value or nominal value is the value stated or the amount stated on a bond, right? It's just like a principal amount. We will get there. Then another thing which we will look at is coupon, coupon rate. What is coupon? Coupon is the interest rates, or it is the stated annual rates on a bond. Or coupon rate is the interest rates of a bond. You borrow 500,000, of course, you pay interest. The interest under bond valuation bond is called coupon, right? If this is established, we will talk about zero coupon bond. Zero coupon bond. I've not seen this type of bond before. I don't know if Mr. Victor has seen this type of bond. Zero coupon bond. I will borrow you money. Then, at the end of the day, you will not pay me interest and principal. Mr. Victor. In this economy. Ah, where is favor? Exclusive. Oluwapemisire, Rachel, Comfort, Bidemi. Is that possible? Rachel or Rita, you you say I should borrow you 500,000. You say this type of bond is zero coupon bond. Okay, oh, that you will not pay interest. We have, though we have, that is Islamic.
If na family matter, it's possible.
It's now in a family matter. Some will
Government
say,
grants.
ma,
Government grants.
government grant. Government grant, is it a loan? Mm, okay, it's zero rated. You won't pay any amount. You at least you will pay. You may not even pay much, but at least you will pay money.
That's why
You
they call it free risk security.
No, 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 no. I disagree with you with that statement. If they say something is free risk does not mean that you will not pay anything on that. Free risk means that whether government make profit or they don't make profit, they will pay you back your interest and principal. That is not it is not part.
Okay,
Why
so
they call it
government
free?
grant is similar.
Government grant is similar, but you will pay. What you are going to pay back may be below the market price. But being it a risk-free does not mean that you will not pay. Risk-free is different from coupon. We are talking about, are you going to pay interest or not? In as much that you will pay, you will pay. It is not zero coupon bond. It is not zero. We are not
Okay.
talking about the risk part.
Okay, sir. Okay, sir. Thank you, sir.
Do, do you get, ma?
Yes, sir. Thank you, sir.
Thank you, ma. So, that is, okay, favor a family matter. Hey, it is rare. So, that is zero coupon bond. When you're talking about zero coupon bond, these are bonds that do not attract any interest at the date of maturity. It does not attract what? Interest at the date of what? Maturity. Now, another characteristics of bond,
But excuse me, sir. Sir, this zero bond, does it exist?
that's what I'm asking now. Wait, I'm
A bond
asking
is a
question
debt
too now.
already. So for a loan or something to be called a debt means I think it has a redeemable period or you have to pay back.
That is what I'm asking. I asked this question. Oh. I said, oh, do we have such bond? Does it exist?
Maybe theoretically, yes.
See, at the beginning of this class, I said, anything that is not practicable, I will tell you, I will let you know. This thing, even it will not work out. Have you ever seen a company that does not pay dividend in Nigeria? That does not pay dividend in Nigeria? Have you ever seen such company?
No, sir.
It will not exist because as an investor, you will be expecting something from your investment. As what? As an investor, you will be what? You'll be expecting something from your investment, right? You'll be expecting something for, and you say, oh, you are not paying dividend. If you are not paying dividend, that means that it is through capital appreciation. I want to divert. Sorry about that. I was talking about something else, right? So now it's premium. Now, premium bond. Abdurrahman,
Okay, I only wanted to say that you say what if it's a company limited by guarantee? You know, the company limited by guarantee, they don't pay dividends.
company limited by guarantee. But the company limited by guarantee, are they listed in the Nigeria stock market? Can you give me an example of that such company in Nigeria?
They are not listed on the in the stock exchange market because it's a charity company. It's for the
So, mm,
for charity
mm,
purpose.
mm. Interesting. Any company that pay either dividend or through capital appreciation. Don't forget that investor can get their returns in two ways, either capital appreciation or dividend, right? And if such company is not listed in the Nigerian stock exchange market, how do we want to talk about the dividend, right? So I'm talking about where investors, general public, where investors can just go and extract information and check, oh, this company did not pay dividend this year. This company paid dividend this year. We'll talk more about this in equity parts, right? Mr. Victor,
Yes. Yeah, please.
okay, please put down your hands. I think,
Okay.
okay, thank you. Thank you, right? I have a lot to say when it comes to investment, but we have to move on because of our time. Premium bond. What is premium bond? Right? Premium bond. Premium bond is a bond that the market value is greater than the par value. A premium bond, you can say this particular bond is a premium bond where the market value of that bond is greater than the par value. Don't forget, I said par value or a nominal value or a face value could be either 1,000 or 100, depends on the examiner point. If they say par value, that means 100. If they say nominal value, that is 100, right? So the premium, when the market value is greater than the par value, you could say, oh, this bond is at premium, right? We could say what? This bond is at what? Is at premium. Another thing is discount bond. Discount bond is the opposite of premium bond. You could say this particular bond, we will illustrate that on how it works. When discount bond is when the par value or the market value, let's say the market value is less than the par value. The market value is 10. Let's say, for instance, the market value is 90. The par value is 100, right? The par value is what? 100. You could say this premium is at a discount because the par value, the market value is less than the par value. Now, for the purpose of this class, I will just limit it to 5 characteristics of what? Of bond. Of course, we have a floating rate bond. right? But what will we use for the purpose of ICANN as well as ACCA? This is enough for you, right? Now, if this is established, we've looked at the definition of bond, the characteristics of bond. Now, the valuation of a bond. Class, valuation of a bond. How do we value bond? Right? Valuation of bond. Valuation of a bond. Class. The question now is, in every question, the question will say, oh, calculate the value of a bond. Right? Calculate the value of a bond. Or, if it is not value of a bond, or theoretical value, right? Theoretical value of a bond. The question will say, calculate the value of a bond or theoretical value of a bond. That is, you want to determine the market value of a bond. You want to value a bond, right? Now, valuation of a bond means that you want to determine you want to get the market value of that particular bond. What will be the market value of this bond? Is this bond at premium or at discount? So when you hear a question say, oh, calculate the valuation of a bond or theoretical value, means that you want to determine the market value of a bond. That is what it means, class. When you want to determine the market value of a bond, what are the things you need to take into consideration? Class, I need to confirm this. Are we still together? Are we still together? Please unmute your mic.
Yes.
Sure, sure.
Yes.
Okay. We are together, right?
Forever.
They play. They do it. They play. Okay. Valuation of a bond or theoretical value means market value of a bond. When a question says determine the value of a bond or theoretical value of a bond, it means that you should determine the market value of a bond. Class, how do we determine the market value of a bond? Class, how do we determine the market value of a bond? What are the ingredients? Don't forget that when you want to cook soup, class, when you want to cook soup, you will need some ingredients, right? You will do what? You will need some ingredients. Raula needs now, or Rachel, when Rachel wants to cook soup now, Rachel will need some ingredients like Maggi, salt. If you like, don't put Maggi. You're on your own. So now, don't forget, I said valuation of a bond means the market value. You want to determine the market value of a bond. Then, when you want to determine the market value of a bond, you need some ingredients, elements. You need some elements, right? Or the ingredients you will use to determine the market value of a bond. One, interest rates of that bond. The interest rate may be from year 1 to year 4, right? After that, the numbers of years, number of years. Then you need the nominal value, or the face value, the nominal value or face value of that bond. which could be 100 or 1000. Class, there is no year zero here. Oh. Let me quickly say something here again. Class, under cost of capital, under the cost of capital, bond is a debt to the company, right? It is a debt to the company. It is a debt to the company. Under the bond valuation, we are looking at bond in the perspective of a lender. This is what you are expecting. This is what you will get. Now, that is why you don't need year zero here. You don't need year zero. The valuation of a bond is used to determine the market value of a bond. When you want to determine the market value of a bond or theoretical value of a bond, there are some elements you need. One, the interest rates. The lender will receive the interest at the end of the period. What is the face value of that bond? Of course, like a government bond, that is about, I've forgotten the amount. I think about either 5 billion something of recent. It's a recent something. I saw it. Like, okay, you can value it. You can determine the value. If they say, oh, it is for 4 years, right? You can determine the value of that bond by saying that, oh, what will be the interest elements from this so year to this year? The numbers of years. What will be the nominal value, which means the face value? The nominal value is like a principal value. It's like a principal amount, right? So with that, within 4 months or 4 years, you will know the market value of that bond. Then you will now look at it. Is it favorable? Oh, is that discount or at premium? Right? So when you are to determine the value of a bond, you need 3 elements or 3 ingredients. Right? One, the interest elements of the bond, which is the coupon rate, the numbers of years, the nominal value of that particular bond. So we will now determine we will now look at it. Oh, is this bond, is it at par or at premium? Dear professional colleagues, right? So that is my explanation on that. So let's quickly look at an illustration to the valuation of a bond. When you hear valuation of a bond, it means that you should determine market value, class, market value of a bond. Then when you want to determine the market value of a bond, there are some elements you need, the ingredients you need in cooking this soup, right? Now, the interest, the numbers of years, and the nominal value of that bond. Class. Another thing is, is the yield to maturity. Supposed to ask, what will you use to discount it? Yield to maturity. This will take us to yield to maturity. Okay. So the yield to maturity is your DCF that you will use to discount that particular bond. Yield to what? Yield to maturity. Right. You will use yield to maturity to discount the what? The bond. However, most times, yield to maturity will not be given to you in the question. We will get there. But for the purpose of this class, for the purpose of this illustration a question that we want to solve now, we will assume that the yield to maturity is given to you in the question. The question now is, what is yield to maturity? We will get there. Right? That will be given to you. So now, let's quickly look at an illustration. You must write. You must do what? You must write. I don't actually have a note. I don't have note on the valuation because 2 to 3 classes we are done with valuation of a business, right? Valuation, bond valuation, right? I don't have notes on valuation at all. This is just what I have, right? On valuation. Now, let's quickly look at an illustration on how to determine the market value of a bond, right? Don't forget, when the question says value of a bond, it means market value of a bond. When the question says theoretical value, it means the market value of a bond. You need to ask yourself question that what are the elements you need in determining the market value of a bond? These are the interest, the numbers of years, the nominal value, and the yield to maturity, which may be given to you, or if it is not given to you, you have to determine the yield to maturity. Now, illustration one, example one, exclusive.
So please, I just want you said when you're determining the cost of a bond is like a debt to a company, and when you're determining the value is like I didn't get that part with you. Sorry.
Okay. I said under the cost of capital, bond is a debt, is treated as a debt to the company. When you are treating a bond valuation separately from, although it's a debt instrument, separately from the cost of capital, like this now, right? Like this now, it is a return. It's like a return to the lender. Of course, you will pay interest to the lender. The nominal value, which will be either 1,000 or 100 in theory, right? Yield to maturity, what will you use to actually use to discount this particular this particular bond, right? So all these elements, interest, nominal value, is for lender because you want to determine the value of is it at premium or at discount. Do you understand?
Sorry, sir. Does tax also affect this one?
Tax?
Yes, sir.
No. That is what I'm trying to differentiate, right? That is what I'm trying to differentiate. That for the purpose of look exclusive, calm down, calm down, calm down. Drink water. Or let me see your video. Wait, show me. Let me see your video. Can you show me your video?
Hey, no.
See, I get come up for here. So now I would have said you show on your video. Let's see. Calm down, right? When you are looking at bond in the perspective of a company, in the perspective of a company class, there will be a tax relief on that bond. There will be a tax relief on it. Then when you are looking at a bond in the perspective of a lender, well, you don't need tax. There's no tax there. There's no tax. Will the relevant tax authority charge the lender? No. There will be a relief to the borrower. That is why there's no tax effect. Exclusive. Do you understand? Exclusive.
Yes, sir.
What of
Yes, sir. Yes,
what of
sir. Yes,
withholding
sir.
tax?
Oh, interesting. Interesting. That is a very good question. we, we for the purpose of ICANN and either ACC, so we will not talk about withholding tax. Of course,
Silence.
of course, when you meet a financial advisory, someone who advises in terms of investment, well, may not really tell you that if you buy government bond, oh, let me use commercial paper. No, let me don't use commercial paper. Let me just use bond, for instance. That out of this 50 million bond, out of this 50 million bond, you want to buy like 10 million bond. And your return on investment is like, let's say, it's like 2 million. The person may not tell you that 2 million, you will not get that 2 million. Oh. There is a withholding tax on it. There is a withholding tax on it. That, oh, at the end of the day. But guess what? The withholding tax of regulations of 2004 state that interest elements that arise as a result of direct debits from the bank. Direct debit, okay, that one is for bank. That one is for bank. So it is allowed, withholding tax is allowed. But the interest elements, for instance, you deposited money into the bank account for, let's say you leave the money for like 4 months and it will yield interest. The bank is not supposed to deduct withholding tax on that return. They are not supposed to do that because the withholding tax regulation of 2024 state that any form of interest that arises as a result of direct debits from the bank, it is exempted from withholding tax. But guess what? Anything you think is not possible in the whole world, it is happening live in my dear country. You see, silently, banks deduct it. They do, right? But it is not allowed in paper, right? So that one is, by the way, is silence. Thank you, Madam Linda. Thank you, Favor. God bless Nigeria. So, where are we? I say God bless Nigeria. Everybody just mute.
And no place else.
I
And
beg you.
no place
Eh?
else.
You say?
You said God bless Nigeria. I said and no place else.
I know place else. Okay, okay. Interesting. That's fine. Okay, now let's quickly look at an illustration. Or should we go for break? Because this is 1:35. You said, Ma?
Sir, continue. We've not gone.
So please, let's go for a break.
I actually want to do something. That's why I said, can we go for break? But it's fine. It's fine. I can round up. I can round up. Okay, please. Let me